Hello and welcome to the Investing in Frontier Markets panel. Frontier markets provide access to some of the most dynamic and fastest growing economies in the world. Whether we're talking about the Middle East's oil reserves or Africa's natural resources or Asia's newly industrializing export industries, the one thing these frontier economies have in common are strong, sustainable growth drivers. To chair the panel, we are welcome to have Dr. Feriani. He has taught finance and investment at George Washington University, after which he has worked as a portfolio manager covering Asia, North Africa, and the Middle East. His firm, Advanced Emerging Capital, launched its Frontier Markets Fund in 2007. It now covers Asia, the Middle East, Eastern Europe, North Africa, and Latin America. Please join me in welcoming our panelists.
Just going to stand up for a second. I'd rather sit down again. Well, thank you very much for the opportunity. Delighted to be here with you this morning. Fascinating topic, fascinating conference. Well, I'll introduce my panel in a second, but I'd like to start by saying a few words about frontier markets and what they may mean. We've had interesting conversation upstairs amongst ourselves, and it's all about definition, really. If you go back to the 70s, some people used to refer to many of these countries today as third world countries, or LDCs, less developed countries. And then we moved on into a more politically correct definitions, such as emerging markets. So from 1987, we've seen the term emerging markets coined by someone at the IFC, which is part of the World Bank, and then the rest is history. So emerging markets have become quite mainstream today, and the reality is index providers are very important in terms of deciding what is deemed as emerging, what is deemed as developed, and what is deemed as rest of the world, which some of us name frontier markets today. So emerging markets for the MSCI, which is the main index provider, is about 20 countries. Most of them are today very mainstream. So the BRICS, Brazil, Russia, India, and China, as well as the likes of Korea, Taiwan, Mexico, South Africa, etc. And then within that group of emerging markets, 20 or so, there's very small ones from an index point of view, the likes of Egypt, Morocco, which are kind of marginalized in a way, even though they are part of that group. And then you have the developed world, obviously that's another 20 countries. So that leaves about 150 countries that are not accounted for in a way in the investment world until quite recently. The likes of MSCI finally decided to create something called frontier markets. And even in that index, MSCI Frontier Markets, which is very new, it's only been around for a few years, they've captured about 25 countries in there, bulk of which are Middle Eastern countries, the Gulf countries, excluding Saudi Arabia for that sake, because it doesn't tick the boxes of investability according to the index providers, as well as countries like Vietnam, Northern African countries, etc. And Argentina has been demoted from the emerging definition into the frontier definition index a couple of years ago. Argentina has gone basically downhill for the last several decades from developed market status, actually, back in the last century and the 60s. It used to be one of the biggest investment propositions, into then becoming an emerging country and then demoted to frontier, again, as per the index providers. From our definition as a business, frontier is really the whole world except for the developed markets and the mainstream emerging countries. Now, there may be a speaker from Goldman Sachs later on. I hope she is here, and she may touch on Goldman Sachs' and Jim O'Neill's way of looking at the world. They have developed something called the N11 or Next 11, which all the panelists with me today would be familiar with, and then the growth market definition. And that's what we like. We like to think of the growth world and the non-growth world. So Without further ado, then I'd like to bring it back to the panel. I've got with me 4 very interesting characters, put it that way, very impressive bios on your booklet. So I don't think it'd be fair to spend only 30 seconds on each. So I assume, and I would hope that you would make sure that you take a look at all these bios. But from left to right, from my left to my right, we have Juan here, who will have a bit of a bias towards Latin America, and then I'll let him basically tell us his thoughts on the couple of issues we'll touch on with that in mind. Then we have Bill next to him, Bill Browder, who does emerging frontier the whole lot, but his initial expertise used to be Russia anyways. That's how I've known him over the years. First time I've met him was in Moscow. Then we have Kenny with a bit of a Chinese Asian, I think, angle into whatever he's going to tell us about. And then last but not least, Zachary. So I'm going to go back and sit down and then try and moderate to the best extent I can. We have a couple of issues to touch on. That's rather dangerous, actually. Right, so a couple of issues we'll touch on, and we'll try and leave about 15 minutes to Q&A. The worst panels are those that don't leave any Q&A. So I do not want to be part of a panel, especially moderating it without any Q&A. So we'll leave about 15 minutes for that. In the meantime, a couple of issues we'll touch on. First of all, why invest in frontier markets? Why now? Then what are the risks to investing in frontier markets? It is not a one-way bet. There are risks. Investing is about risks, and we're certainly, when investing in frontier and the emerging world in general, there are some significant risks, and hopefully each of our panelists will give their own views on what we mean by risks. There's also an issue of perception there. Some places are perceived as riskier, and it depends on what you mean by risk. Then last but not least, how do you invest in these frontier countries? It's all very nice to talk about them, but can you invest? Are they investable? How? And when is the best timing? So, well, maybe I'd like to be organized, so left to right, right to left. So I'll start with Zachary.
That's nice.
Even though he did not expect it. But,
no, it's okay. I like to be surprised.
That'll keep you on your toes. So why invest in frontier markets? Why now?
Well, I think it's always good to use generic labels, but more than anything else, I think it's always going to be deal-driven. So, I mean, particularly from our perspective, and I was actually thinking about what you were saying while you're speaking, so it's good that you called on to me. But
you're listening.
Yes, for once. No, but I think what's really key is that, first of all, you know, not all frontier markets are the same. You know, whenever we talk about Africa, and Africa has become a new buzzword, and I know the next panel is going to be on Africa as well, there's always this concept, particularly when you're geographically so distant, to treat something as a homogeneous block. And frontier markets, I'm sure, also comes in, you know, under the same sort of scrutiny. Now, we all understand that, you know, obviously there is a major dramatic growth story that is at play over here. Sooner or later, barring any major disasters, there has to be some level of equilibrium or equilibration between frontier markets, EM, and the developed space. The question is, and particularly from a perspective of a fixed income trader, that what is your duration risk? And as I would say, you know, not all frontier markets are the same. So it's really going to be dependent on the opportunity and the elasticity of what you're identifying there. I'm going to just be borrowing from where TLG Capital initially saw the opportunity. We saw it in a pharmaceutical plant in Uganda. That's what led us to leverage and bootstrap ourselves onto healthcare in Africa in general. So one thing led to another. So I think when people say, why invest in frontier markets? Well, you know, frankly, I would have said 2 years ago, it wasn't a great proposition to invest in frontier markets, simply because yield levels in Europe were nearly as competitive as what you would see in the frontier space. So obviously EM was not the trade then. Now in an environment where the next 2 years we're entering into a negative rate rally in the UK, for instance, where are you going to find yields? And sooner or later, the only place for a yield hunter has to be the EM space. There are only so many distressed CLOs out there that can, you know, that their junior tranches can be restructured into some sort of asset-bearing class. But I think, you know, EM is going to be in a very interesting cycle simply because the corporate bond rally has been done with. Equities now at multi-year highs. So I think in the next year and a half, 2 years, people are going to be very, I mean, investors and real money and institutional clients are going to be very, very interested in, you know, double-digit returns that frontier markets can offer. I hope that was good enough, you know,
well,
as a first speaker.
Well, we're slightly biased, as you may appreciate here, as frontier market fans. So you take that one with a pinch of salt, probably. Kenny?
Yeah, I mean, you know, basically, I'm trying to give a generalization of frontier markets in my mind. I guess a simple way to put it, like you said, is anything which is outside the MSCI Emerging Markets Index. And, you know, people associate frontier markets with political instability. People associate markets with catastrophes in which these countries cannot handle. People associate these with a relatively immature capital markets. And the way I look at it, on the other hand, on the other side of the coin, these represent huge opportunities. One, for example, in Cambodia, the only way to get financing is through microfinance and also non-government owned entities. So that means the borrowing cost is very, very high. So that means foreign capital can enter and negotiate better deals. And these countries, to me, they represent a state in which demographics is a lot better. The crowds are younger. They can produce goods for developed countries and then become consumer themselves. So to me, it's kind of like a repeat of the China story like 10, 20 years ago. So that's why I always wanted to find it the next wave where the development should be coming from. And the more I look into it, you know, emerging markets, great, it's come on a long way. Frontiers, definitely opportunities there. But as you mentioned, you know, I mean, every single market is different. But as a generalization, I would like to give you some of my ideas why we should be looking at it more carefully now and consider it as an investment. I think I'm a person with numbers. I like to deal with numbers. And if you look at the entire frontier markets, if you look at the stock markets, it does offer very, very decent returns. For example, for the last decade, from 2000 to 2010, frontier market produced as much return as emerging markets. But however, the standard deviation was actually lower than emerging markets. So on a correlation basis, you're getting non-correlated returns. So hence, for a large pension fund, for a large fund manager, they should be the first one who should be looking at this, because it's less volatility, less correlation, better non-correlated returns. So these should be the drivers in which that should get their attention on day one. And secondly, if you examine these countries individually, every country has its case. I mean, in Asia right now, I mean, there are 4 up-and-coming ones, like Laos, like Myanmar, or Burma, if you like. Myanmar, Laos, Cambodia. I mean, these are going to be, and Bangladesh, of course. I mean, these are going to be trading giants. With the liberation of ASEAN cooperation, you know, the barriers is going to be lifted, and on top of that, you know, Laos has got WTO. So, you know, to me, you know, on a diversification basis, and also on the next coming wave of, you know, freedom of trading, I think the timing is probably now. And on a timing basis, if you want to be scientific again, looking at the historical discount, we're probably talking about the frontier markets trading at a discount around like 20% to emerging markets if you look at vis-a-vis PE ratio basis. So if you're comfortable with the discount being at 20%, of course, if it trades, at high discount, you can always try to buy more. And, if you feel that the discount is coming off less, meaning there could be potential convergence between the valuation of emerging markets and frontier markets, then there's probably a time that you don't necessarily feel that you can buy more. So on a timing thing, I think the valuation comparison could be a pretty useful tool. So I'm just talking about frontiers market more from a mathematical point of view.
Thank you. Thanks very much for that, Kenny.
So why would you invest in any market? And the answer is you would invest in a market or a stock if it's either cheap or it's at the same level as every other stock, but it's going to grow faster. And so, and the same thing would apply to frontier markets, emerging markets, developed markets, anything. I got my start in my career in Russia in 1993. And at the time, Russia had just gone through a massive privatization program where they gave away all of the state companies for free, and they started trading on the market. And they traded at about a 99.7% discount per barrel of reserves, per unit of electricity capacity, per telephone line, depending on the type of company. And so it was obvious in that particular case that it was really cheap, 99.7% discount. But it was cheap for a reason, which was that you didn't know whether in 6 months' time the government was going to renationalize everything. You didn't know whether you were going to be held up at gunpoint. You didn't know a lot of different things. And what happened was that they didn't renationalize. For the most part, people didn't get held up at gunpoint. And the values of everything went, in the case of my fund, we made something like 40 times our money from when we started to when we finished. Now, there's kind of a sad ending to my story, which was that I was kicked out of Russia and my lawyer was arrested, tortured, and killed. And so I can't necessarily say it was a good experience by any means, certainly a bad experience. But what I can say is that everybody asks me afterwards, okay, well, where's the next Russia? Where you can get a 99.7% discount. And I can say honestly, and I'm sure that all my co-panelists will agree, that there's no place that's trading at a 99.7% discount. I think you're talking about 20% discount. Therefore, if you can't get stuff cheap, then the question is, are there places that are just growing so fast that by paying a normal price or a 20% discount, you're getting something that's growing at a company or an economy that's growing at 30% or 15% or whatever, while everything else is stagnant or shrinking. And here, you can't generalize. There are, I can't remember how many countries there are that fall into this category.
150 plus?
But out of 150 countries, every country's got its own thing going. So I've recently taken a look at Iraq and Mongolia. Those are I think, 2 of the 10 fastest growing economies in the world. And I actually got excited about Iraq because it trades at I think it trades at 4 or 5 times earnings. And depending on if you believe the numbers, there's 40% earnings growth. And that sort of sounds good. But having said that, then you have to say to yourself, okay, if it's cheap or if it's growing faster, what kind of risks are you taking in frontier markets? And you definitely take much bigger risks in frontier markets than you take in emerging markets or developed markets. Frontier markets are by definition sort of lesser of the lesser developed countries. And in a country that's lesser or lesser developed, one day they can be capitalist and market oriented, and the next day there can be a change in government and they decide they're not. Even if the government is fine, you can end up in a as I think we were facing last year, where there was a global contraction of liquidity. And with a global contraction of liquidity, who doesn't get money are the most fringe places. And if the fringe places don't get the money, what do the central bankers do if money is flowing out of fringe places where they have a very limited amount of money? They say you can't take your money out. It's called capital controls. So you run the risk of political change, you run the risk of capital controls. And then you also, depending on the country, if there's 157 of them, you run the risk of illegal things happening in the country that you can't fight against. That's how I ended up getting kicked out of Russia, was we started fighting against illegal things happening in the country. And so all these things need, I don't think you can generalize, but all these things need to be weighed off against one another. And again, in the context of what you get elsewhere in the world to decide whether it makes sense or not. But I guess what I would say in conclusion is that things have to be either really cheap or growing really fast to justify the risks of capital controls getting ripped off or political change to justify investing in frontier markets.
Thank you, Bill.
Yeah, to continue, I agree with Bill. I mean, it's not that frontier markets are interesting in themselves. There is everything there. To add a bit the Latin American perspective, because that's where we invest as a company, you know, what we are looking for is places where the perceived risk is much, much lower than the real risk. And that's what's shifting over time. You know, you have in Latin America, Venezuela, Bolivia, Ecuador, Argentina. These are really troubled countries where it's difficult to invest. Maybe things are very cheap, but you don't know for how long you're going to own them. You don't know if you're going to make money or even be able to get your money out of those countries if you eventually exit some of those investments. There's some other aspects. For example, we focus a lot in Peru, in Uruguay, in Paraguay. These are frontier markets in the sense that capital markets are not very developed. These are not countries where you have heard a lot of foreign investors or institutional investors participating there. But where the political situation today is safe, you know, that's also the reason why so many people are interested, is that you look at the world today, it has changed. Maybe there's less political risk in Peru, in Uruguay, than in France or Italy, as we see what's going on there. So maybe that's where the safe investments can be done today, but at the same time it's growing more. And I think one key reason why to invest and focus in those countries is that it's less competitive. You know, you are looking for opportunities where there's more returns and more deals to be made than the investors chasing those things. So the way we look at Latin America is focus on areas that are growing, that are politically safe, and also from an environment and corporate governance point of view are changing. You know, there's new generations in all of these countries. I think over the last 20 years, the people doing business in Latin America coming into the different aspects of responsibility are different than 20 years ago. It's happening also in Africa or in Asia. So I think the opportunity is realizing that these places have changed, that they are safer, that there's a good investment returns to be made with less risk than is perceived by the market.
Thank you very much for that. Well, I'll have to chip in also and give my thoughts as to why invest in frontier markets and why now. I mean, as a business, we invest in emerging markets or frontier markets. That's it. That's what we do. And that's where we think the excitement is going to be in the next 10, 20, 30, 50 years for that sake. So we are very much long term. And just like some of the panelists already mentioned, it's important to have a framework, because otherwise, you know, why invest in anything? Our own framework is to look at 4 things: quality, valuation, growth, and change. So we look at the quality of the fundamentals of a country. We take it one country at a time. It is a big number of countries, after all. There's 200 or so worldwide. If you look at the FIFA list of countries, or if you look at the Olympics, how many countries participated in the London Olympics? There's about 200 or so. So you take away the 20 or so developed countries, as they call them, and that's debatable. Is the UK more developed than some places like Korea? I'm not so sure on the technology front anyways. So you take those out, you take the mainstream emerging, and then that leaves the frontier. So we look at the quality of the fundamentals of the balance sheet, sovereign balance sheet, corporate balance sheets, household balance sheets. We all know that these are very important things to look at before going into any place, and we know what's happening with the Eurozone problems. We look at the growth. We like the growth. At the end of the day, the emerging market story started back in the late 80s because of the growth that you can get from these countries, and that links back to what Bill mentioned. And that is certainly a common factor in all these emerging and frontier type of countries. So we look at the GDP growth, but we also look at the corporate growth. We want to invest in companies that are growing, because very, very often, particularly in the early stages of development of countries, you have some very interesting GDP top-line growth, but then you can't see it trickling down to the corporate level, at least in terms of earnings. And then we look at valuations. Everything has a price. And again, linking back to what Bill mentioned, there's a trade-off in terms of valuation and growth, and then risk and reward trade-off. So we like cheap stuff inherently, and it's easier to get into something cheaper. The cushion and the downside is much better than you go into something that looks so attractive, but all the good news are priced in. And then last but not least, we like the change. We like positive change. We like to look at positive structural change. Not all countries move in a positive way. So places like Argentina, unfortunately for the last so many decades, it's been negative change, one after another. Zimbabwe, same type of story, versus lots of other countries out there, whether it's the Vietnams of this world or the Bangladeshs of this world, and obviously Africa. No one can ignore Africa today. 20 years ago, lots of people just wouldn't even look at it, but it's moved on dramatically. That is a huge continent. It's massive, and there's 55 countries or so. And therefore, in terms of positive change, you only need to go and visit these countries. And that's where the reality versus perception gap is phenomenal. The perception is so negative, but the reality, by and large, on the ground is far better. And I think that links back to what Juan mentioned. The reality perception gap is where the opportunity is, we think, in terms of the frontier story. And why now? It's because they've come a long way. They've come out of economic obscurity 20, 30, 40 years ago into global economic relevance today. And yes, you could tell I'm a bit biased because I have a lot of money invested in the frontier strategy. I've committed the last 9 years, 10 years or so of my career to this space, along with the emerging. So I do buy into it. And on top of all the positive fundamentals, I think I mentioned what also Kenny said as far as low correlation. It's a no-brainer. I'm assuming, and I'm definitely sure, that at the LSE and the basics of investments, you talk about portfolio theory and construction of a diversified portfolio, etc. It's a no-brainer to have at least some allocation to the emerging, but certainly to the frontier asset class. And I do say asset class. We've had a bit of an angle on the fixed income side of things and credit. There's currencies, there's property, there's private equity, and there's direct equities, which is our preferred route in general. So low correlation and lower volatility, lower risk, we think, makes for a no-brainer allocation. So moving on swiftly to the next bit about risk, because it's all nice by and large, particularly if you're a patient long-term investor. And you don't want to be in a kind of a hit-and-run type of seat, really. This is not for a hit-and-run type of story. It's more for at least us. We're not hedge fund managers, so we leave that to the traders. So what are the risks, really? So going back the other direction so that I keep everyone awake out there. So are there any risks at all? And what kind of risks are we talking about when we talk about frontier countries like Uruguay, Paraguay, Argentina, etc.?
Yeah, we focus only in private equity, so we need to operate companies on the ground. And the reality, the operational reality of these companies is that they are most of the time not up to standards in terms of reporting. You know, when you acquire a stake in a company that is a $10, $20 million company in Peru, they rarely have an audit, they rarely have IFRS accounting, they rarely have processes and checks and balances. So you need to really do more due diligence before getting into something. You know, I think it's an area where passive investments from far away are difficult to control. So you need to really get involved into the companies. I think it's areas where, as there's less institutionality, personal relationships and human factors are more important too. I think getting to know the people operating these companies, getting to know the reality of really working and dealing on these countries on a daily basis is very important and critical, because that's where the risks are. The counterparty risk is not legal, it's really structural, and even from a relationship point of view, that's where if you lose the confidence of people, you may not have access to the information or to liquidity in your investment. So I think it's more hands-on that creates opportunity, but potentially a lot of problems, as you are less protected as an investor from an outside point of view.
Thank you. Bill?
Well, I'm probably the living definition of emerging market risk. I'm not going to talk about it in general terms. I'll tell you specifically. I became the largest. So I started in Russia when it was a frontier market, and then it developed into an emerging market. And I became the largest foreign portfolio investor in the country. And I discovered in all the companies that I was investing in, and I would say pretty much all, that the people who were running the companies were stealing large amounts of money from those companies. And so, I mean, and we're not talking about CEOs paying themselves an extra million or two. We're talking about managers stealing $1 billion through kickback schemes or whatever. And so we decided that that wasn't an acceptable way for them to run the companies we invested in. And so we decided to research how they did the stealing and then expose it through the international media, which had a remarkably positive effect on the share price when we did it. Every time, in normal Western markets, you expose corruption and people didn't know that the companies were corrupt and the share price goes down. In Russia, if you exposed corruption, people said, wow, maybe the corruption would stop and therefore the share price went up. And we did that very successfully for a number of years. And then one day I was flying back to Russia and I was stopped at Sheremetyevo Airport. I was detained for 15 hours in the airport detention center. And then I was deported from the country and declared a threat to national security. The police subsequently raided my offices in Moscow, seized all of our corporate documents. And the next thing we knew, we didn't own our companies anymore. The police had let a murderer out of jail early who put his name on the documents to become the registered owner of our companies. We then hired a young lawyer to investigate. He discovered that the whole purpose of the scam, and I'm giving a workshop this afternoon where I can go into much greater detail, but just in the interest of time today. He discovered that the purpose of the scam was to steal our money, which they didn't succeed in doing because I had taken it out of the country, but they succeeded in stealing $230 million of taxes that we paid to the Russian government. He testified against the police officers who were involved in the theft of the money. He was subsequently arrested, kept in prison for 358 days, tortured and killed at the age of 37. So that's the risk of emerging markets.
That's quite extreme. Very sorry to hear that, but yes. It doesn't happen everywhere, though.
Well, what can I say?
Don't be so negative.
Well, I think we're looking at the Asian markets, Asian frontier markets in two angles. One is markets with existing stock markets in which we can have some participation. What we're trying to do here is to form a fund of fund to actually buy these stocks, more on a longer term basis. So it's your typical, liquidity risk, your custodian risk, your transaction risk, which is nothing like what Ren was saying here. But on the other hand, and the angle we're working at, for example, in Myanmar, we're working on a P project in which, same. The amount of due diligence is going to be like 3 times as hard. And there's standards in which, in our eyes, which we think is okay, which is not necessarily their standard. So it's really a skill on about how you can actually localize and understand the mentality. And I find more than a lot of times, if you don't make an effort to understand what's going on, you can actually miss that opportunities. There were 2 projects that we're working for on behalf of clients in Vietnam and also one in Cambodia. One was a property related, but the balance sheet was just so crazy. Kickbacks, everything, you name it, they had it all in there. But except the actual potential of the project itself was quite, number one, quite scalable, and secondly, quite profitable. And in the end, we became like the doctor doing the dissection and just cutting up everything and, taking out every individual receipt and say, what is going on? Okay, if this is not the right thing, we can't raise any more money, and, maybe perhaps we have to put it all under a clean shell. But the process of that, it just takes, 3 times as long than any other markets you can imagine. So, and we haven't even, went on to talk about the political risk, dealing with the government. Why have you decided to threaten us that the development rate is not there anymore? These things. Fortunately, you have fund managers to to kind of clean all the stuff out before investors can actually come in. But I think in frontier markets, you know, all the managers here, you know, probably spend, you know, 5 times as much as time to get any decent investment onto the table. And I think investors should really appreciate that.
Absolutely.
But like I said, you know, it is worth the effort because, like I said, the potential is really in the frontier markets, and the only way to access to some markets like Myanmar is finding good PE projects in which we're spending a lot of time on. So that's really my experience in dealing.
Thanks, Ken.
Yeah.
Zachary?
In the first round, when Kenny spoke, not this time, the one before, he said something very, very interesting, and I just wanted to touch on that because it sort of provides a thematic context for what we're discussing. And he said the strength in finding opportunities in the challenges. Now, the reason that sentence struck me is because I usually say that, but also this morning I read a Fortune or Forbes article that profiled this genius 16-year-old kid who had discovered a new cancer treatment or a very cheap way of diagnosing cancer. And he was only 16, so they wrote the 5 tips to raising successful children. And the first one is teaching your children how to identify opportunities and challenges. And I think that's really the sort of I didn't read the rest, so I just read the first one, but that was more than enough for me. I sent the rest to my father. That's his manual, not mine. But I think that's a very, very key perspective to how you actually engage. And it's a barometer for how well you're going to do in the frontier space. The fact of the matter is that I have noticed in my time in this jurisdiction or investing strategy or whatever you want to call it, is that most of the people who kind of condescend or patronize or are moaning about how difficult it is to do business, generally what I think, they're not the ones who are ultimately going to be able to survive out in the long term. So, I mean, in the sense that obviously there are many risks. You know, we have political risk, we have sovereign risk. Bill's highlighted, you know, after hearing him, I was thinking, I better take out my money from the frontier market space because that's going to happen. But I would say that there are so many different risks out there. And obviously, from a perspective of an investment strategy, the first thing you do is what is your recovery value? And without strong recourse to a legal structure, you know, your recovery value in some cases could be as low as 0, or you could, you know, even worse things could happen. But I would also say that Michael Milken demonstrated that with the junk bond market, you know, you can also iterate a frontier market strategy. You know, you diversify your portfolio risk, you diversify your sovereign risk, you're able to now, there's a very vibrant insurance market now to mitigate against sovereign risk. For instance, with the recent news in Mali, you know, there's been a lot of talk now on how do you insure your investments in Mali. So, in fact, I think that a lot of the risks that we see as sort of insurmountable ultimately are going to be those great opportunities that need to be rethought and you know, invested in. As an example, you know, when we started going to Uganda, we discovered that, you know, there was limited water supply, and from there, you know, in the sense that, you know, there was limited clean drinking water. So from our investment in a pharmaceutical plant in Uganda, we then sort of were introduced or, you know, got involved with a water bottling facility in the northern parts of Uganda, which are very rich with water supplies or whatever. And now that's the second largest water bottling facility in the entire country. So I think in a lot of ways, it is important to always understand and be able to assess your risks accurately. Obviously, that goes without saying. And frontier markets do present their own set of risks. But at the same time, I would also say is that the idea is to be a yield-hungry and a yield-driven investor, and also look at these challenges as something that's just a moment in time. And just to give as an example, I think I was telling the panel before we joined here, in 1990, China had a lower per capita GDP than Sub-Saharan Africa and South Asia. Now, a Chinese GDP per capita is 5 or 6 times larger than either of those two regions. So obviously, those who bet on China, and I've actually met somebody who was at HSBC 20 years ago. He went to China. He said it was a dump. He wasn't going to invest there. And now he told me 2 years ago that's the biggest mistake of his life. And he's always trying to find the next China. So in a lot of senses, you know, someone's trying to find the next Russia. Someone's trying to find the next China. Hopefully, Africa is able to deliver on some of its promises. And I'm confident that it will.
That's great. Thanks very much, Zachary. Again, I need to remind the audience, I was asked to be a speaker in this panel. and therefore that's what my role is, and then I was asked to moderate. So as far as risks go, I think I should spend 30 seconds saying that there's a range of risks out there, and there's a range of risk levels. At one end, you could put in the likes of Iraq, Iran, Zimbabwe, lots of names. At the other end, you could throw in places like Qatar. It's very small, and small is beautiful sometimes. And why is that? Well, it's because of politics. Political risk is the biggest risk when investing in any country, full stop. Then you break it down into all types of policies, a type of risk, and it makes a hell of a difference to any country's future, actually, present and future. And obviously, Northern Africa has reminded us of the kind of risks that you're dealing with when going into places like Tunisia or Egypt or Libya or whatever it is. Things can happen when you expect them the least, but also places like Argentina, same thing. It's all about the political risks there. Number two biggest risk is corporate governance risk. When investing, you're dealing with, well, at least as far as we're concerned, investing in companies. You take it down to the micro level. And corporate governance risk, when you talk about investing in Korea, and you go back 20, 30 years ago, corporate governance risk was massive. Obviously, it still applies to Russia. But it's all about the marginal change, though. I mean, we're not talking about corporate governance being at the same level as we have it in the UK or in the US. And even then, you would have heard of companies like Enron and WorldCom. So it's not all only limited to the emerging and frontier world. Corporate governance risk also applies to the developed world. And then, you can look at things like ease of doing business here and there, etc. So now I'm going to have to move it straight to Q&A. So I'm afraid we'll have to touch on the last bit as to how to invest in frontier markets after we take a couple of questions. But I do want to bring it back to the panel towards the end, 30 seconds each, to wrap up and tell us about where and how to invest. So the floor is yours. If you have any questions, if you don't, I'll be quite offended. Okay, I see one hand raised there. So we'll start with that one. Two, and then we'll take it to a lady because we need to mix and match a bit. So 1, 2, 3, and then. So we'll
just
start with that one.
Yeah, just there. A quick question in terms of investing in these frontier markets. I mean, it sounds like it's quite difficult at times to know which horse to back. And you made the example of a guy going to China 30 years ago and seeing it as a dumb. Sub-Saharan Africa hasn't moved since then. Is the only way to invest in these markets to do it on a diversified basis?
We'll have one of the panelists, so don't raise your hands all at the same time. Who wants to take this one?
I would say that if you want to make money, you can only make money on a concentrated basis. If you want to keep your money, you can only keep your money on a diversified basis. And if you were to diversify across emerging markets or frontier markets, there's a pretty good chance you're not going to make any money. You have to be focused, and you have to be concentrated in order to succeed in the way that this guy from China didn't succeed or whatever.
Take a look at my company's website too. That's no advertising. Second question.
Thank you. I was wondering about corruption. Once investing into a different country, one of the biggest issues is political corruption and politics. When you invest, how would you go about protecting yourself against the corruption? Or would you rather play the actual game and actually take advantage of corruption?
Can I spend 2 seconds on that? And our approach is to believe in local expertise. So I go back to what Juan said. There is no way, sitting here in London, you could really invest in 150 countries or so, even 50 or 20. So we use 80 partner teams, people like Bill, et cetera. We rely on them to do the homework, roll up their sleeves, take some death risks in some cases, but that's our way of doing it. Because obviously the information age means you have access to a lot of stuff, but expertise is important, and this is not for the faint-hearted or for some beginners. But I'll like to have one of the panelists also touch on it. Besides Bill. Anyone else?
No, well, I'll tell you because it's a reality that many of these countries have a big corruption problem, both at political level, but also on corporate level. You know, it's not rare to want to do a business with a certain company and to have a certain employee asking for a bribe. So it depends a little bit how you organize as a business. We try to turn that into a competitive advantage in finding capital. If you want to capital from the big pension funds today, from big institutional investors, you will have to have very strict ways of dealing with this. And actually, it's going to be a condition. Not only it's illegal today through a lot of legislation handling how you can do business in foreign countries for some investors, but it's also a requirement in most of the subscription forms that people sign today, for example, to invest, or not having access to debt financing from big international institutions. So it's a reality, and I think it's the right strategy to try to embrace all this new corporate governance and be an actor for change in these countries if you can have an impact on how business is done there.
Thank you. We have to take a question from a lady back there. There were two ladies. Which one? Yeah. Should have been ladies first, but hey.
Thank you. My question is to Mr. Kenny Lee and Mr. Zachary Latif.
Thank you.
I would like to ask you if you think there are opportunities to start developing e-commerce market in Asian frontier economies.
E-commerce. My fiance is in e-commerce. I hear way too much about it for my own good. But from what I can understand, e-commerce in an Asian setting, well, I think e-commerce, like I think in some cases I've seen in like Europe as well, it's beginning to develop. I know in India, for instance, it's become quite a large market there. But as for ourselves, we haven't yet. It's also what our investment interests are: healthcare, agriculture. So we haven't necessarily gone on to the technological aspects. I think Kenny would be far better to, you know, it's not something we look at as much.
Yeah, I think technology in this case is going to help a lot of these frontier markets develop a lot faster than what we would expect. I mean, let's not talk about e-commerce, but let me give you a very, very specific example about telecommunication, for example, right? You know, in the past, like 10, 15 years or so, you know, emerging markets countries trying to build out a fixed line network, okay? They spend trillions of dollars, you know, buying copper just to do wiring, to do fixed line. And guess what? You know, now with these emerging markets in Asia, in Latin America, they don't even want a fixed line system because everyone's using mobile, everyone's using an iPhone. So technology does have that competitive advantage for the new and growing economies. And your question to e-commerce, I think is going to be the best thing on earth for these new economies to do e-commerce. I mean, I'm still, you know, flabbergasted and amazed by the level of e-commerce in China. And if these can be reapplied to smaller countries, we can be more efficient. I think the result could be, you know, just as good. You know, so in your question about these e-commerce type of business or growth in emerging markets, I think there's huge opportunities because, you know, they are still building the infrastructure, and if you could somehow adapt some e-commerce business model along with, to complement with the, you know, build out of new infrastructure. For example, in Myanmar, they're going to have to revamp the whole infrastructure in the entire country. And if you've got great e-commerce solutions to complement with that, I think that's one of the biggest, well, perhaps you're going to go over and learn the language and build your business there. I think it's a good thing.
I just wanted to touch on what Kenny said. He actually inspired me when he used the words telecommunications. I was thinking, why do we avoid technology the way that we do? And what's interesting is I think also there are some sectors that have very good buzzwords. And for instance, telecommunications in Africa, 10 years ago, Africa had fewer phone lines than New York City. And now at this day and age, Africa has more mobile phones than the United States. So obviously there's been this huge catapult. And you know, they've been able to skip so many cycles of development, which we in the West have gone through. But I would just say that so the problem is that while these industries are definitely going to grow, sometimes you have saturation risk. And ultimately what we are trying to do is go in those industries that don't necessarily have saturation risk. So I think technology is definitely something very interesting, but there's a lot of money already directed towards that sector. So it's trying to find that niche.
Yeah, one of the most sophisticated mobile phone companies in the world is a Kenyan company called Safaricom, actually. And what they do with mobile phones there, the UK is definitely not developed at that level. And the Kenyan market is super sophisticated. It's a bit frustrating time-wise, because I think we can spend the whole afternoon. I certainly can. And I probably should come back as a guest speaker at the LSE one day and touch on a few of these issues. So we're going to have to move swiftly on. Can I ask how much time we're left with, given the delays? Is that 30 minutes? 30? I was hoping 30. Well, I'm afraid we're going to have to wrap it up with where to invest, and then maybe we'll get an extra 5 minutes. I mean, food is not that relevant, I think, frankly, lunch-wise. So, I'm just mindful of the next panel. But can we just wrap up as far as where and how to invest? And I mean 30 seconds, 30.
30, okay.
Seconds. Yes, please.
I would say that, like, for instance, our next investment jurisdiction is Southern Africa. We're looking at Zimbabwe, so we're looking at those nations that have had political risk and are now emerging onto better times. I think also how to invest, it's super important to look at the structure of your investment. Are you doing direct equity? We prefer convertible bonds, and also we've also switched from being a fund format into an investment vehicle company. So I think it's also about managing duration risk, which a lot of funds that have been in frontier PE have kind of forgotten. 30 seconds?
Well, that's 29.
Thank you.
Great.
Ken.
Miami is my favorite Asian frontier market.
Did you say Miami?
No, yes.
Could be.
Both works. Okay. Miami is pretty frontier to me as well. Okay. But Miami, I mean, that's going to be the next big thing. Sanctions are going to be lifted. More and more sanctions are going to be lifted. And the way we're going to play it, well, we love the fact Miami has great gas resources. It's got about 2 trillion cubic feet of gas, huge resources. The nation is, the literacy and they're very the cultures is very education based, and we're going to look at energy related businesses. And we're launching a fund with a partner who is, we're getting Soros-backed money as well. So we're looking very specifically in Miami at the moment.
Great, thank you.
Shouldn't you go next?
Well, I'll go last.
Okay. It all depends on how you go about investing, where the opportunities are. There's a lot of countries that are exciting that basically don't have capital markets to invest in. If you have the capacity to go and set up shop or get involved in private businesses, there are great or there are booming countries in Africa like Angola, Mozambique that have all sorts of new oil and gas wealth that creates interesting things. There's Mongolia, which barely has a capital market, which is also interesting. The one place, and I don't do any of these things professionally, I don't do any of these things as a business, but I am involved in some ways as a private investor. The one thing I have done recently, which is exciting, is one of my colleagues left to start up an Iraq fund, and that's where I get these numbers of 4 times earnings and 40% earnings growth, and you should talk to him if you haven't already. Iraq is a country which has a small stock market, and you can invest in it from abroad, and it has a booming domestic economy and no foreign investors, and lots of money that's sloshing around in banks and consumer companies and so on.
But you can't get local custody. You have to sign a paper to someone there.
Well, this is going to be a problem with many.
That's one of the risks, obviously, you run. In the case of Iraq specifically, we look at it, and you have to sign a paper and trust that person that they'll be looking after it. And that's a bit too much of a risk for some, but the opportunity is fantastic. Yeah.
Well, as private equity investors, we try to focus on a longer-term horizon. So what we are asking ourselves is, what is the world going to need 10 years from now, and who is going to be willing to pay a big amount of money for that? And one of the areas we focus on is agriculture. Food security is going to be one of the main strategic topics of the next 10 years, and particularly for the countries that have the most funds to invest, China, Middle East. So Latin America supplies around 20% of the world exports of soft commodities. And it's a sector that almost doesn't have any organized company. It's in the hand of just a few worldwide traders. So we are consolidating agriculture assets around Latin America, and you have to do it in the areas where, for example, you can buy land without foreign ownership restrictions, and where the cost of production is relatively low. Once you control that, you will be able to sell food into the world market at higher and higher prices. So one of our biggest investments is land in Uruguay. It's 3 million people, produces food for 100 million people. So we'll be able there to sell food at higher prices to whoever needs it tomorrow. So it's just one idea and one macro trend we are working on.
Thanks very much, Juan. So I think from our perspective, again, accessibility and investability is one of the issues when dealing with frontier markets, but it's certainly far more investable and accessible today than 20, 30 years ago. And it's the early mover advantage is important, and that's our belief. So the early mover advantage will give you some bigger upside than if you waited another 10 years, just like with the emerging story. And where to invest, I mean, all asset classes are up for grabs. And when you start off a low base, the upside is phenomenal. So whether it's equities, direct or via private, equity, fixed income, property, FX, you name it. Our core expertise is in primarily equities with a bit of property and private equity and in a diversified way. It's all down to your risk appetite or risk aversion for that sake. We think diversified portfolio and patience pays off. Our own frontier strategy has 40% in Africa. 15% is the biggest exposures in Nigeria, and then the rest, bits, about 10% in Saudi, 10% in Qatar, and Vietnam, Kazakhstan, etc. So again, you can put all your eggs in one basket. It's just a matter of how well can you sleep at night, knowing that everything is in Russia for that sake, or in the case of frontier, if it's in Myanmar or whatever. And it's also about the time horizon. So very frustrating that we're constrained by time. And many of us, at least, or if not most of us, we're going to be here at lunchtime. So please stick around, and hopefully my fellow panelists will be around to answer any of your questions. It made me feel that I'm back to the classroom, having left about 16 years ago. It's been a great pleasure, and we thank you all for your interest. And thank you very much for the fellow panelists.